Hey everyone, it's Imran from Options Insight, back with another macro options spotlight. All right, so stocks rallying pretty hard into the end of the month, end of the quarter, led by tech. Nasdaq doing pretty well. Technically back into a bull market, up 20% from its December lows. So really having a nice go there in the tech space. Europe was also strong on just the general better risk sentiment, and China had a bit of a pause, consolidating that big 4% gain from the day before. Commodities were also stable. Gold did drift slightly, but copper and oil holding steady. And nat gas and uranium also look like they're forming a bit of a base. So, encouraging signs there, let's say. If we're looking to the vol side, we do see vols continuing lower. So you've got about one and a quarter vol point drop across the board there in Europe and US. And, in general, it seems like we've run into an area where dealers are a bit long. They need to shed some Vega exposure at these spot levels around 40, 50 and above. And they don't want to hold on to too much theta decay going into Easter. So that's going to be why vols getting sold. Commodity vols were also lower pretty heavily, 1.5 to 2 vols, and then nat gas down nearly 5 vols there. And same sort of story, right? As Easter approaches, in general, vols have had their pop last month, and people are now sitting here. If things are calming and stabilizing, which it looks like they are for now, we're going to go into that quiet period of a couple of weeks into Easter. People don't want to be bleeding too badly, and that's why you see implied vols reset lower. It may well be a buying opportunity, though, at some point. Now, skew is lower again, not massively in the US. Ignore this NASDAQ number because it's flying around like an animal. I don't trust it. But the US number, the S&P number is more accurate, 34% percentile there. Europe did come down close to a vol point, so that was looking a bit more expensive, still in around the 40 to 50 percentile level as well. Slowly but surely we are seeing skew head back lower. It does make sense, right? If a lot of money has fled to safer assets like money market funds, then there's going to be less need to hedge equity downside. Remember, that's why skew underperformed so much last year, because no one owned the market. Then everyone got rushing back into the market in January because, the market was rallying and people were a bit more optimistic. And then all of a sudden now people are spooked again, have gone to safe havens, and they don't need as much exposure to the market. So they don't have as much exposure to the market, so they don't need the protection against that. So that's why it makes sense that we would see skew come back down a bit if people have de-risked. Okay, looking at the charts, Megacap tech running the show. So the performance of those broad indices, we've kind of flagged this already, has been distorted by the performance of a few Megacap stocks. So if you look at Meta, Amazon, Apple, Microsoft, and Google, since the start of the year, that basket is up about 19%. And if you look at the other 495 companies in the S&P 500, they are pretty much flat on the year. So all of the performance of the S&P is coming from these names. And that's what's making the index look far more resilient in the face of a worsening economic outlook than it otherwise would do. We've also got the AI boom that's going on, has also given a strong bid to semiconductors. So if you look at the SOX index, which is semiconductor index, that's leading the S&P higher. As you're going to get a demand for chips, growing, as there's going to be an exponential increase due to AI for the demand of semiconductors, because all these companies that are going to employ AI to improve their businesses and take advantage of this potential productivity boost are going to need these chips to make that AI work, basically, right? So we think we can see that happening in the price action of semis, and then if you look at the implied vol in tech's been falling, and you can see that from the levels of the Vixen, which is the NASDAQ version of the VIX. So that's coming back down towards its lows. And then Apple as well is pretty much at its lows, if not lower. So Apple vols are quite cheap. So for those who have managed to catch this tech rally recently and done well from that, then going into something like the PCE inflation data this Friday, which, if it was to come in hot, and it does tend to kind of follow what we see in CPI, which was accelerating, then it might make sense for you to stock replace some of your tech holdings into call options in tech because the vols come down so much. So there's something to think about there. Okay, if we then have a look at what fixed strike vol's been up to, always good to see what's going on under the hood in fixed strike. So as we've rallied since since last Friday, we've rallied about 1.5% on S&P, and we had been suggesting that it was likely we were going to grind up into month end. This 40.65 strike is that big JP Morgan collar strike for 31st of March. So, to tomorrow. That seems to have had some gravity and dragged the market up towards it. I think there's other factors driving the market higher as well. In general, just kind of that bearishness coming out of the market slightly after being quite nervous. So that helps. But then, I think we're going to struggle to break materially above 40.65 until after tomorrow rolls off, because that is a $20 billion notional strike that we know the street is long. But you can also see that the dealer positioning is clearly long by the fact that the fixed strike vols all getting murdered, right? So all of these are down, over a vol point from April, May, and June expiries. So really showing you that dealers are choking somewhat on gamma and offloading options where they can, and that drives fixed strike vol lower. Further confirmation that street is probably long gamma here as well is that 5-day realized vol got as low as 5% this week. It did have a little bounce on yesterday's rally, but that's pretty, clear evidence there that dealers are more likely long gamma than short. And then the VIX has fallen back below 20 as we suspected. This is why we've been running short VIX via our puts and put calendar structures that we've got in our overlay portfolio. So those have been performing reasonably well. It may well be the opportune time to get out of those tomorrow into month end if we do get that final pop into month end. Now, the truth is this JP Morgan collar tends to have delta to execute on the day. So if we're below that strike, then there may well be some marginal buying or selling to be done on that actual print into the close. So that's something we should maybe be aware of and think about. That does often have a little bit of market impact, because that can be about $10 billion to execute, right? But in general, if we're sitting there pretty close to the short strike, which we are, then actually that's pretty much a 50 delta option or close to a 50 delta option, and the new delta of the new put spread collar ends up being similar to that, so it might not have that much marginal impact if we are quite close to the strike. If we're materially below the strike, if we're at, let's say, 4,000 or below, then it's going to be a case of those calls don't have any delta on them, and then the execution will be a net sell. But if we're up there, then that might not be the case. Okay. Anyway, that's kind of what we're seeing in terms of the positioning, and it's being confirmed by the fixed strike vol moves. And then just a little bit of a trade review, really. Obviously, gold has been a big performer recently. That was the one safe haven that really caught a spectacular bid, along with the likes of Bitcoin, but I'm still a little bit wary to call that safe haven. But on the 28th of February, which was about a month ago, we did recommend, based on what we were seeing on our dashboard, based on what we were seeing on the technicals on gold, we recommended a trade where you basically sell silver puts and you use those to finance calls on gold, and the kind of notional you could get was multiples on gold. So that was an efficient way to own a gold rally, pay no premium for it, get some leverage to the upside. So since that trade it's done very well. Gold's up 8%, silver's up 12% in about a month. So obviously, if you did sell those puts on silver and we're up 12% in a month, and they don't expire till June, but they've lost 75% of their value. I mean, they were worth about 17 to 20 cents when we recommended that trade, and now they're worth 4 cents. So it's a no-brainer really to buy those back, right? They've still got, best part of 3 months till they expire, and yet they're not really worth anything. So buy those back as a risk management trade. Bank the money of selling those out and buying them back at a much cheaper price. Not a lot you can make out of them now anyway. And then if you are long these 192 calls on gold, which only cost you around 68 cents, they're worth about $3 now. So they've made nearly 5 times their money. So you could just bang them out and take the money and say, okay, that's been a good trade. Or if you're still bullish on gold, which most people kind of are, given the conditions, then you might want to sell a higher strike against it. Something like this. Okay, that's it for today. Thanks for listening. I'll catch you all tomorrow. Cheers.